Okay, good morning and happy Friday, everyone. Welcome back to our Friday morning market outlook session. My name is Tony Zhang. I'm the chief strategist here at OptionsPlay. Let's go ahead and get started. We have quite a bit to unpack here today for you. But before we do, what we're going to discuss here today is purely for educational purposes. It is not a solicitation or recommendation to buy or sell any specific securities. So we have quite a bit to go over here today. We'll always start off with our market update as usual of the broad-based indices. And we want to show you a little bit about how the leadership has narrowed a bit and the breadth has narrowed. And these are some of the concerns that we currently see. And I certainly feel like a bit of a broken record here over the past few weeks as we see the exact same market action that we've seen for the past few months, and a lot of investors asking how can this market continue to move higher. So we want to talk a little bit about what we see, what risks we currently see, and how that translates into our views for the direction of the overall market. Now, this past week, a lot of the news is predominantly around yields and the change and the sudden change that we've seen in yields and the impact that has had on commodities like gold and silver. Economic and consumer metrics, I think, also is worth taking a look at because we have seen some reversals so far in some of the economic numbers and consumer metrics, and knowing that consumer discretionary and consumer sentiment driving a lot of the economy here, it's important for us to understand when that starts to reverse because that is potential signs of the markets continuing to move lower. So we want to make sure that we are aware of that. And today what we're going to do is we're going to do a full sector review. We're going to look at all 11 sectors and see where they currently stand and what changes we've seen in terms of rotation for the sectors. And at the very end, if we have a few minutes, I'll try to answer any questions we have. But the question that I want to try to answer, and again, this feels a bit like a broken record where investors continue to ask week after week for the past few weeks, is to, are the markets going to reverse lower? So I want to see, are we finally going to start seeing, market top and start to see markets reverse lower? My name is Tony Zhang. I'm the chief strategist here at OptionsPlay. Today, what I'm going to do this morning is share with you my charts, the research that I'm currently watching, and the ideas that we currently have given the current market conditions. So let's go ahead and get started. So we'll start off with the Qs, the NASDAQ 100 index, because if you look at the Qs, it pretty much is a straight line up, which isn't too different from what we saw from November to February. Now, one of the concerning things that we continue to bring up here on the Qs, despite its rallying past the February 2020 highs, is that on every subsequent push past that resistance level, what we see is continued exhaustion on the markets where momentum is not confirming these moves higher. That leads us to believe that there's going to be a fairly sizable and violent pullback, but the problem here is that just because you have exhaustion, just because you have markets that are overbought, you have complacency in the market, that in itself does not signify you're going to get a pullback. There needs to be a catalyst. We don't quite have a catalyst. There are quite a few, I would say, risks on the horizon that could potentially spark a decline, whether it's the stimulus package, whether it's geopolitical risks with China, whether it's vaccine related news. These are all things that could potentially be a catalyst, but none of these have sparked an actual pullback yet. Now, the longer markets continue to push into this exhaustive state, usually the more quick and fast the violent the sell-off is, like we saw here back in February. Now, obviously, the coronavirus, no one could have possibly predicted that. But what we could have a good sense for is how quick and violent those sell-offs are going to be based on how stretched markets get before that sell-off. And arguably, markets are quite stretched. So those are some of the risks that we continue to see in this market, that despite these risks, the prevailing trend is still bullish. There's no question about that. And that's why we still continue to seek bullish positions. But we are very what's different now as far as seeking bullish positions is how we go about seeking and how selective we are in terms of picking bullish positions. We need to make sure we wait for pullbacks to enter bullish positions, and we need to make sure that we use option strategies that can define our risk so that if a catalyst appears and the markets sell off, that we're only risking a small percentage of the stock or ETF that we're playing using options. So that's been the prevailing trend and the prevailing theme that we've had over the past few weeks. And this does not change. And despite the fact that markets continue to move higher with the signs of exhaustion, that in itself is not enough of a reason to outright go short. Now, the S&P 500 is just shy of its all-time high of 339. We're within spitting distance of that. I would expect that perhaps today we might get a push towards that. I don't know if we're going to get above it, but certainly markets are seeing signs of exhaustion here as well. Similar to the push higher from November to February, markets look very similar to that. There was signs of exhaustion, but in the S&P 500, looking a little bit more constructive, resolving some of that negative divergence. So S&P 500 actually looking a little bit more constructive than the Qs, which is predominantly technology and biotech. Now, if we look at the small caps, we've talked about small caps for quite some time. Whoops, this is equal weight. Small caps, the big level that we were paying attention to is 160. We talked about this as a target. We reached that target, and now the market has bounced off of that level. It has pulled back a little, consolidated, and the question is to see whether small caps can push back above 160. If it can push back above 160, then the market breadth remains relatively okay for the health of this market rally. It certainly is lagging behind. It is nowhere near the all-time highs like the S&P, and certainly have not exceeded the all-time highs like the Qs. So small caps lagging behind, but for the most part, still keeping pace with the overall market for the most part. Equal weight is continuing to lag behind. This is, again, further signs of the concerns that we see in this market. Normally, when we see near market tops, what you generally tend to see is mega cap stocks drag the markets higher while the equal weight indices lag behind. That's exactly what we're seeing right now. It's what we saw back in January and February. As markets continue to march on higher, we did not get the equal weight indices to continue moving higher. And we're seeing that across the sectors as well. It's not just the overall market. If we look at consumer discretionary, if we look at even technology, we're seeing that the market cap indices in those specific sectors are greatly outperforming the equal weight versions of those sectors. So that is concerning to us as far as the market top. So for all of you that are out there feeling that this market cannot continue to move higher, and you're saying to yourself, why does this market not reverse lower? It's not just you, it is everyone. But again, you need to trade with the trend, and the trend still is at this point bullish. We are waiting for a potential catalyst, but that catalyst has not arrived yet. So that is our main thesis. And again, I feel a bit like a broken record to keep saying this week after week, but that is where we currently stand. Now, I would say the big news this week was the move in 10-year yields. It moved back up to the 20-week moving average, which the last time it happened, it got rejected. So for those of you that remember the quick spike we had in XLF and banks back here in early June, we saw a very similar reaction to the markets here this week, where banks were the best performing sector this particular week as rates continue to rise. We also saw this dent gold and silver rallies, because as real rates get higher, or as rates get higher, what you basically see is gold and silver decline, because gold and silver are non-dividend paying or non-yield paying assets. So whenever you have yields rise, that's an inverse correlation to gold and silver. So this is one that we're watching very closely to see if this just fails again, like we had last time, which at the 20-week moving average failed. We're just shy of the 20-week moving average right now. And the question is whether rates will continue to move lower. Now, my hunch is at this point, is still for rates to move lower as a result of this. So this is a bullish gold play. This is a bearish XLF or banks play. But we'll see if rates can spark this move higher. Inflation did move substantially higher here this week, which is potentially a strong, a potential headwind or a tailwind here for yields moving higher. So this is one of the themes that we're paying attention to, because this could potentially be the start of a bullish move here in yields. But my hunch as of right now is still that we're going to see a continuation lower, but that could change. And this is one of the things we're watching closely. So as a result of yields moving higher, what we've seen is gold move substantially lower. Now, again, my long-term view is still for gold to continue moving higher, because we expect interest rates to continue moving lower. When you have hundreds of rate cuts across the world from global central banks, trillions of dollars, $8 to $9 trillion in terms of liquidity being pumped into the economy around the world, that is going to have a downward effect on rates. And that, generally speaking, is good for gold and silver. So the fact that gold has now declined below the 20-day moving average, from my perspective, is a good entry for a long here on gold. So for those of you that maybe have missed out on the initial move here for gold, here's another opportunity to potentially go long. Same thing in silver. Silver managed to just touch the 20-day moving average. It has already bounced quite a bit. It is a bit late to the party, but if you do think that there's further gains, the best way to play this is using calls and call spreads. That protects you against a big whipsaw down to the downside. So if rates continue to move higher, I would expect silver to very quickly get back below 23 and 22 into the low 20s, perhaps even the high teens, if rates continue to move higher. So you want to protect yourself from that downside to play for further upside using option strategies like buying a call or a call spread. Crude remains stuck here in this $42 range. Now, the fact that you have dollar weakening and continuing to weaken, but crude does not move, this is still, in my opinion, a worse outlook for XLE and the energy stocks. I think those stocks will continue to underperform, and I'm looking for potentially further short opportunities in this particular sector. This is the only sector that I'm really looking for some short opportunities. Perhaps an XLF, and when we do our sector reviews, I'll bring that up. But I wanted to show you, crude not moving is certainly concerning to us. Now, for those of you that follow us very closely, you might have seen the webinar on how to hedge your portfolio. And in that webinar, we talk a little bit about the ratio of the 3-month VIX to the ratio of VIX. And we talk about it predominantly in the context of when it falls below 1, that's a risk off metric, meaning markets are about to sell off or markets are going to sell off fairly heavily. And that's exactly what we saw on February 21st when it moved below 1. What we don't really talk about very much is when VIX 3-month and VIX goes above 1.25, which is a very complacent level. This is usually signs of a market top. So what we're seeing here is that markets, the VIX 3M has kind of fluttered around this 1.2 level for the last couple of days. It's still staying in that range in the 1.23. So this is something that we're watching very closely because these are the signs of complacency, just like the put-call ratio, the 20-week put-call ratio at all-time lows, 20-day put-call ratio also at all-time lows. This is showing us there's a record level amount of complacency, a record level of calls being bought to a ratio of puts, meaning markets participants really playing for a lot of upside with almost no regard for the downside, no concerns about the downside. And that type of complacency is what we typically see near market tops. So, but however, one thing to remember is, we also had record lows here, also had record lows here, also had record lows here. So just because you have a record low, again, does not mean that it's time to buy puts. And this is probably, I would say, the hardest thing for many investors to contend with, is having this feeling that things don't feel right, valuations don't look right, markets don't feel like it should be trading here, but not pulling the trigger and buying puts. That is probably, I would argue, one of the hardest things to do, but best practices show us statistically it does not make sense to buy puts just because things are stretched, just because valuations are crazy, and just because markets are complacent. You want to wait for that sell-off. What you want to do is you want to be patient. Now is the time to sell cover calls, sell call spreads, especially if you feel that markets cannot continue to move higher and momentum has stalled. Sell call spreads, sell cover calls, collect premium. And then when the markets start to accelerate to the downside, once we have a catalyst event that can drive the markets lower, that is when you can use the premiums that you've sold to buy puts with it. So what I wanted to show you is some of the consumer confidence and recovery metrics that have started to stall. This is part of why I think markets have seen a little bit of a a pullback here, and I wouldn't call this a pullback, a stall in the momentum here. So when we look at mobility trackers, they have really been flat for the last 8 weeks, and we have 5 out of the last 8 weeks where they've moved lower here. And consumer confidence really for the last couple of weeks have not moved higher, and has actually just started to tick a little bit lower. I would say this is arguably because of the lack of consensus in terms of what stimulus will look like. We have already passed the July 31st date. We're almost 2 weeks, more than 2 weeks into not having a strong understanding as to what stimulus is going to look like, what the healthcare system is going to get in terms of stimulus, what schools are going to get. This is putting a dent in consumer confidence, and I think this is part of the reason why we've seen a lot of the slowdown and momentum here in the equity markets. There are still plenty of upside risks as well. You know, the vaccine being the top one in my mind, because you know, we saw Russia put out a vaccine earlier this week. There are some concerns as to the validity of that vaccine, but countries around the world are racing to try to get to that vaccine. And first possible vaccine here in the US could be late Q4, possibly early Q1. And there are some, you know, signs that perhaps it might even come in earlier than that. And those are the types of upside risks that we still see in the market. And those are the types of news events that could cause this to start moving higher and continue to move the markets higher, because there is a lot of cash out there. If there is good news, I do not see any problems for equity markets to continue moving higher. And I know that sounds crazy, but I could easily see the S&P 500 at well above 339, 340 on the S&P, and the NASDAQ 100 index continue to move higher if we see these upside risks as well. It's not just downside risks like geopolitical risks and things like that, but there are upside risks as well. So with that, what I want to do is I want to do a quick sector review. And what I have is all 11 sectors, and I've organized them from the strongest sectors to the weakest sectors, so that we can get a sense for, you know, how the spectrum of the sectors currently sit. They're currently running a pretty wide spectrum. You have some very weak sectors, you have some very strong sectors, and you have plenty of sectors here in the middle that are starting to rotate around. So I want to look at all the sectors and see where we're starting to see some shifts. So first of all, XLK, technology, certainly signs of exhaustion here. Similar to the Qs, as we continue to push higher, momentum is not confirming these moves higher and actually moving lower here. Money flow remains fairly strong here on both the daily and weekly chart, but as you can see, that weekly chart still has that massive negative divergence that has not been resolved. And as you can see, it pretty much has been a straight line higher without any consolidation. That, generally speaking, isn't particularly healthy. And when you have long and extended periods of continuation higher without a consolidation or a pullback, that means that generally speaking, you tend to have more violent pullbacks. Now, technology arguably fundamentally is the strongest sector from a fundamental perspective, and that's part of why the sector is still strong and still holding up throughout this. XLY, consumer discretionary. This is the part where we do see a lot of exhaustion here. Same thing, you have a higher high in the weekly chart. Momentum has not confirmed that higher high, but money flow remains very strong on both the daily and weekly chart. But one of the things about XLY is that XLY is a market cap weighted ETF, meaning predominantly you have Amazon, Home Depot, McDonald's, and Starbucks that consist of almost 50% of the index, those 4 names alone. But there are about 60 plus names in this particular sector. And the vast majority of that 60 are actually underperforming severely compared to Amazon, Home Depot, McDonald's that have outperformed this particular sector. So this is really one of the concerns that we have, especially when you overlay the consumer confidence numbers around this type of sector. This is really the sector that I see the biggest risk of a pullback, because fundamentally the sector is not nearly as strong as the technology sector, which has substantially higher margins and is arguably far more defensive from a recession than consumer discretionary. So this is one of the sectors that I see a high amount of risk of a pullback. If we look at communications, similar type chart, we have a massive divergence here on the weekly chart. Both the daily and weekly money flow remains fairly strong here. So this is supportive of this of this particular sector. Now, communications not as strong as healthcare, but from a fundamental perspective, makes more sense that communications can continue to move higher than consumer discretionary. Communications, as we shift our habits from working from an office to working from home, our communications needs, whether it's streaming or broadband, continues to increase, and this is generally speaking supportive of the communications sector. So this is one that I particularly like, that is not as strong as technology and consumer discretionary. It is slightly under the radar for most investors, but this is really where I see some opportunity here for further gains in communication. Now, materials has been particularly strong over the past few weeks, but it is contending with some major resistance levels here in the 62, 64 range. It has really stalled here a little bit in that 62, 62 and a half range. And the question is to see whether it can continue to move higher above 64. Now, if we look at the long-term trend of XLB, as you can see, it really hasn't performed at all over the past couple of years. The outperformance of XLB is actually significantly underperforming the overall market because it has had no progress over the past 2 years. So despite the recent strength that we're seeing, overall, this is still one of the weaker sectors in the S&P 500. So this is part of why I feel that, you know, the $64 level here for XLB is going to be a tough level for it to get above. If it can get above, then that's where we could potentially see a massive reversal here for materials and see materials move substantially higher, but it has not cleared that $64 level. We'll continue to pay attention to this and update you if materials does break out above that 64. Now, industrials has come back to life a little bit, similar to XLB materials, but as you can see over the long term, over the past couple of years, no progress while the markets continue to move higher here. So XLI, interesting on the short term because it managed to break out above that $76 level that we talked about here a couple of weeks ago, managed to break out above. We're coming back to retest this a little bit as support. I do expect to see some substantial, some further gains here for XLI. So you have the $85 level. That would be the next target that I would see here on XLI. You have some small gaps to fill here in the 83 level here, but those are my targets here to the upside for XLI. We do have a pretty nice breakout here to play. Healthcare has consolidated for quite some time here for the past almost month above this 105 level. So right now the question is whether healthcare can continue to move higher and break out from this level. That's the one that we're watching right now. Now, I tend to see that the healthcare sector fundamentally still is fairly strong. You have strong daily and weekly money flow here. So this leads me to believe that you can get a breakout here above this 107, 108 level here in XLV. And this is one that I have on my radar as a potential breakout. I like this along with industrials and communications because it's not as you know, on our radars in the news cycle every single day. Predominantly news cycle is dominated these days by technology and discretionary, gold, silver, you know, healthcare, communications, industrials, not the ones that breaks headlines every single day. And these are the types of opportunities that I prefer looking at rather than the tech names that are dominating headlines. Now, consumer staples continues to see some pretty good strength here. It is just within spitting distance of that all-time high, about 65 here. So the one thing about consumer discretionary and consumer staples is that as it continues to march higher, momentum has confirmed those moves higher. You still have the $65 level to contend with, but if it can break out above it, that puts us in a much better position here for consumer staples. As you can see, as a sector, much better looking than industrials and materials, even though those sectors looking fairly strong over the past couple of weeks. I think consumer staples is really a better sector to look at here from a potential breakout perspective long-term, because consumer staples is at least performing on par with the markets here over the past couple of years. Real estate continues to weaken here. Real estate really has not seen a lot of strength. It got rejected at the 200-day moving average in the beginning of June. Looks like it's getting rejected at the 200-day moving average again here over the past couple of weeks. My expectation is for real estate to continue moving lower. If you look at the commercial and residential real estate space right now, fundamentally doesn't look particularly strong. If you look at the lending standards of banks for these types of loans, they are severely restricting this. This tells us the type of concerns we're seeing from this industry, and that's why I think real estate can continue to move lower here. So I'm looking for opportunities to sell call credit spreads here in some of the retail real estate names, because I think that there's going to be limited upside here for real estate, especially as if yields continue to push higher. This is generally speaking a tailwind here for real estate. So the weakness that we're currently seeing is concerning to me of a stalling. We're seeing similar type of play out here in utilities. Utilities, same thing, getting rejected at the 20-day, 200-day moving average. Now, utilities is very neutral here, and utilities is very sensitive to interest rates. So there is potential risk that if interest rates continue to head lower, that utilities could break out here. So this is one that we're watching, but my base case still at this point is to look for a continuation lower here in XLU rather than that breakout. But this is one that we are watching because it is trading in a very tight range here. Whenever things trade within a tight range, they tend to have big breakouts, either to the upside or to the downside. My hunch is that it's to the downside, but it's yet to see. Now, when we look at financials, this is the one that I was telling you before. When rates took off in the beginning of June, XLF rallied really strongly and got rejected at the 200-day moving average and the 200-week moving average. Now, we've gotten a small rally again here this week when rates moved higher, and it just rallied up to the 200-day moving average. And the question is whether this will continue to move lower. Now, because my base case is for rates to continue moving lower after this rally, that's why my base case here for XLF is to see a further decline. And I wouldn't outright buy puts yet, but I would look at selling call credit spreads where I would sell maybe a 26, 28 credit spread. You can do this on XLF. You can do this on some of the banks, especially the weaker ones. Maybe some of the regional banks, the ones that are most sensitive to interest rates, those are the ones that I would play and look for a continuation lower here, or at least a sideways market here, because if rates do continue to move higher, you will see a breakout above this 200-day moving average. You have a lot more upside then if that happens. But until that happens, my base case is still for a bit of a grind lower, a slow grind lower here for XLF. And lastly, XLE, the weakest of all sectors. And there is nothing particularly strong to look at here. And if you look at the daily chart, it looks almost like a bit of a head and shoulders formation now. And again, base case here for energy is to continue moving lower. This is the only sector where I'm looking for some real bearish opportunities, because as you can see, it got rejected at the 20-week moving average. Looks like it's about to get rejected at the 20-week moving average again. Daily chart does not look constructive at all for a rally. We don't see gold, we don't see crude rallying anytime soon. The fundamentals don't look particularly strong. So my base case here is for energy to, at the very least, trade sideways and grind a little bit lower. So using strategies like selling a call credit spread here makes a lot of sense. Selling like a 40-45 credit spread or 40-43 credit spread, something like that, that allows you to capture yield as long as XLE stays below, let's say 41 or so. If you do get a rally above 41, then perhaps at that point we've seen a move in crude. Maybe we've seen the shift in fundamentals in crude. You know, from my perspective, it really takes a huge, massive reversal here in global economies in terms of demand for crude, for industrial demand for crude to really pick up. And we're just not seeing that right now. So that's why my views here on energy are still quite poor. So with that, that covers what I wanted to share with you here today. Now, I just want to do a quick bit of housekeeping here. For those of you that follow us every single Tuesday and Friday morning, I am out next week. So we will not be having sessions next Tuesday and Friday morning, but I have an action-packed week for you. The week that I come back on August 24th, we're going to resume these Tuesday and Friday morning sessions. But I have Tom Sosnoff with me on August 25th at 4:15 p.m. We're going to be doing a strategy session with Tom, because many times whenever I have Tom on, all of the questions predominantly evolve around how does he trade certain strategies, what are his best practices for each one. So what we're going to do is we're going to do a strategy session. We're going to go over each strategy that that we like to trade and tell you what expiration dates, what strike prices, what best practices we use. Markets are just opening up right now, roughly about flat on the open here, kind of in line with what we're expecting right now in terms of these exhausted markets not having a lot more momentum here to the upside. So please, I hope everyone has a great weekend, and thank you so much. We'll send out the recording as soon as we finish here today, and have a great week next week, and I'll see you guys the following week on the 24th. Have a great day.